Hello, everyone, and welcome to our webinar on diversification, easy diversification with US listed ETFs. The webinar's title is Achieving Asset, Sector, and Demographic Diversification with US listed ETFs. So, here's what we'll be covering today. We'll be covering what are ETFs, what they are, and why do they matter to us so much. We'll also be covering 8 types of ETFs that are very popular in the US right now with examples and trending news about each one of them. We have Bhuvan with us who will also be sharing, few strategies and portfolio allocation on the ETFs part towards the end of the webinar. We'll also cover some of the free resources that you can use for screening the type of ETF that you would like to invest in. I'll be sharing few websites with you, and I'll be going through the websites as well in a very brief towards the end of the webinar how to use resources. And of course, we'll be happy to answer your questions at the end of it on the types of ETFs and any questions you have around it. To begin, what are ETFs? ETFs or exchange traded funds are funds that trade on the stock market just like your individual stock. But instead of owning one company, you own a whole basket of them in a single trade. And the benefit here is ETFs offer you instant diversification at lower costs, and they're transparent about what you're buying, holdings of it, and you have the flexibility of buying and selling during market hours. Quick comparison, like why does it matter, for me to buy an ETF compared to a mutual fund? So let's look at that. ETFs, the diversification compared to a mutual fund, they're both on a high level compared to buying a single stock, right? The difference here is buying an ETF, you can trade them during market hours compared to a mutual fund where you need to place a sell order and it takes a couple of days for the funds to be, coming into your account. And the biggest difference between a mutual fund and an ETF is the fees that you pay. Typically, mutual funds charge you a higher expense ratio compared to ETFs. And I'll be showing you a few examples of them at further down in the webinar. So the power of ETFs is that with US listed ETFs is you're able to capture the entire world economy in a single ETF buy. Their expense ratios are as low as 0.03%. They have high liquidity and you're able to trade and buy and sell them during market hours. And you know exactly what you're able to buy because they're quite transparent on their holdings. And it's very easy for you to diversify your portfolio with a single ETF. You have like 8 types of ETFs we'll be explaining, and you can buy as low as $1 in the US market. So over here, I want to cover what's driving the ETF boom right now and why are ETFs so important and why everyone's looking into buying ETFs. Uh, the biggest highlight is the total US ETF asset is around 11.8 trillion US dollars. That's quite a lot of sum. And we're seeing 677 billion US dollars flowing into ETFs in the first 7 months of 2025. So that's like a record number also. And it's about to reach 1.3 trillion by the end of this year. So that's also another record because we're having a lot of investors wanting to diversify. People are moving away from the traditional mutual funds and moving into ETFs because of high liquidity and you're getting easy diversification at lower expenses. This year alone, 1,308 ETFs have launched since the first half of 2025. So you can just imagine like the demand for ETFs, the type of ETFs that are there in the US market. And some of the trends that we are seeing this year is on AI and robotics. For example, companies that work around ChatGPT, like Nvidia, providing supplying chips to them. A lot of ETFs themed around semiconductors. You have a lot of active ETFs that are there. Then there's the next big craze right now is the Bitcoin ETFs. And a good hot news on that is a 15 billion inflow has gone into crypto ETFs this year. And then you have your ultra short bonds, for example, during the uncertain time of Trump's trade wars. We had a lot of money flowing into short-term bonds because of uncertainty in the markets. And then you also have money going into US markets, international ETFs. That means you're able to invest in other countries' economy with ETFs on those. Basically, they are giving exposure to another country's economy. We'll cover more of it at a much down the road. Now let's look at the universe of US listed ETFs. There are eight main categories, each with its own benefit. For example, index ETFs, sector specific, smart beta, thematic, inverse and leveraged, Bitcoin and crypto, international, and bond ETFs. Over the next few slides, we'll briefly cover each one of them, and we'll also show you some examples as well, some ETFs to go around with the types. To begin, index ETFs are your foundation. They track the major benchmarks like the S&P 500. They are low cost and they provide you instant diversification in the US market. For example, you would have heard the phrase, right? You can just buy the American dream with one single ETF. For example, a VOO. So we have examples like SPDR, S&P 500 ETF that tracks the largest companies in the US market, has a fee of around 0.09%. You have the Vanguard Total Stock Market ETF, VTI, that covers the entire US stock market that has over 4,000 plus stocks in that one ETF. Then you have the Invesco Q Triple Q Trust, which is focuses on the tech focus index in the US market, Nasdaq. Next, we have sector specific ETFs. Sector specific ETFs lets you target specific industries. For example, you see a trend that's happening today in technology. You're able to buy the entire technology sector with one single sector specific ETF. For example, during COVID time, a lot of people wanted to get into healthcare. So they were able to buy healthcare uh, sector specific ETFs. So these are very themed towards a certain sector and they're mirroring the index on that sector itself. And the best use case for these ETFs are tactical allocation. And if you're able to time the sector rotation, you're able to capitalize on market movements. The next category of ETFs is smart beta ETFs. Now, these are very interesting ETFs, like this entire category of sub ETFs that come under this. So think of it like your index ETF, but with a twist in it. So what makes them smart is that they change the percentage. They make a play on the allocation a bit. They are more biased towards a certain strategy in their ETF, and that's what makes them smart. You're able to capitalize on the movement of the market without losing. Without getting a lot of risk. So some popular smart beta strategies include value tilting, growth focus, equal weight, low volatility, and quality factor. We'll start off with what is value tilting. So value tilting is basically it's an ETF that's more favored towards value stock. The benefits of value tilting is lower volatility and potential for long-term outperformance. But let's look at the example, right? Of what's the difference between a value tilting and the mirroring ETF, for example, the SPY, right? SPY is basically a broad market ETF and it's mirroring that, but with a few twists in it. It's focusing more on the value stock. So if you look at the graph, right, you will see like a SPY has outperformed, sorry, SPY is having more bias towards the sectors. One second. Like SPYB is focusing towards financial, healthcare, and consumer staples. And the returns of this ETF, right? SPYV compared to SPY. SPYV, the value ETF, 5 years returns is around 73%, And SPY, the mirror index, right? It's around 84%. Why is the value ETF giving us slightly lower? It's because of SPY outperformed SPVY, the value ETF, due to heavier weighting in the large cap technology and growth stocks, that performed well during the past 5 years. But in the time where financials and healthcare and consumer staples were favored, in those years, the value ETF outperformed it. The next smart beta ETF we're covering is the growth focus. So, what are growth focus ETFs? Growth focus ETFs are basically companies that are having above average earnings and revenue, mainly uh, revenue growth, mainly in tech and innovation leaders. And the mirror of this is going to be the VOO. If you look at the chart on the right, you will see that the the broad index ETF like VOO with a higher concentration in fast growing stocks like Nvidia, Microsoft, and Apple. And if you compare it with VUG, it's heavily weighted towards innovators. And some of the holdings include Microsoft, Nvidia, Apple. So why are growth focused ETFs more important? Like people are buying it because it's designed for people seeking opportunities in sectors driven in innovation, technology, and growth. And they're able to spread investments across several fast growing areas, for example, tech, healthcare, green energy stock. It's something that is more focused towards growth rather than just mirroring the index. So, like I said, it's a little bit of a twist to your index funds. The next ETF that we are going to be covering is the equal weighted ETF. So, equal weight by its name means that regardless of the importance of the stock, it's given the same size. So, this method basically reduces concentration risk by avoiding overexposure to largest companies and big tech or banking giants. So, they equally give everyone an equal opportunity. And one such example is, the Invesco S&P 500 equal weight ETF, which allocates about 0.2% to each company in the S&P 500, no matter its size. Why look into buying an ETF such as this? So it basically is meant for investors who want to diversify without overexposure to the largest name. It's for customers who just want to buy this and then diversify with the other ETFs. For example, with the thematic ETFs that we'll be covering later, it can be used in regards with that. The next ETF that we are covering is low volatility ETFs. Low volatility ETFs invest in stocks that fluctuate less in price, aiming to provide smoother, more stable returns over time. And the benefit of such ETFs is that they reduce portfolio risk and help cushion losses during market turndowns and making them more valuable in volatile or uncertain market conditions. It's meant for customers like people who are about to be retiring or people who are very averse to risk and they're very conservative in their risk management or they're very conservative in their strategy for investing. It's for customers who prefer to play it safe. It's meant for them. The next one we have is quality factor ETFs. So quality factor ETFs by its name talks about quality companies being in an ETF. It's an inverse to the low volatility one. In this, the companies that include should have high returns on equity and stable earnings, including low debt as well. And one of the more popular ones, ETF, is the iShares MSCI US Quality Factor ETF. The ticker is QUAL. And if you look at some of the holdings, you'll see that it contains companies like Nvidia, Apple, Microsoft, Lilly. These are companies with high returns, and they're having stable earnings. The next type of ETFs that we are covering is thematic ETFs, and this is something that I'm pretty sure all of us are aware of, that US market is having a lot of themes when it comes to ETFs. And just to put the narrative out there, uh, after COVID, right, people started putting in money. People started putting in a lot of money during in the tech, and during 2022 to 2024, that is when the markets were, going down again. And a lot of investors started taking out their money from these thematic ETFs. Fast forward to 2025, we are seeing 8 billion inflows into thematic ETFs. And as of July 2025, we have seen a record of $4 billion of inflow in thematic ETFs. It's like it's the biggest since 2021. Some of the hottest themes that include this year are artificial intelligence, robotics, clean energy, gaming and esports, REITs, a very popular one for passive income, and cybersecurity. Like if you want to diversify with companies like Palantir and so forth, you have an ETF themed around cybersec. And it's for customers or investors looking for growth, or they want to follow the trend in the US market. And it's a very easy way to diversify in the most happening trend right now. For example, AI, right? You're able to invest in a theme on semiconductors. Like, for example, there is an ETF called SMH that lets you buy the entire sector on semiconductors. The next type of ETF that we're covering is inverse and leverage ETFs. So this ETF is a very unique ETF get that lets you get two times the returns in a leverage ETF. You're able to get two times the returns of the mirrored stock or index. For example, right? Nvidia, we've seen Nvidia growing because of their record revenue over the quarters, right? And because of the AI boom, they're making a lot of money and they are able to capitalize on the movement. So, Granite shares 2x long Nvidia daily ETF. You're able to get two times the returns of what Nvidia grows. For example, if Nvidia grows 5%, this ETF will net you for 10% growth. And for example, inverse ETFs let investors profit when markets decline. Think of it like, betting against the market. You're able to make money when the market goes down. For example, there's a ETF called the ProShares Short S&P 500 ETF that's designed to return the opposite performance of the S&P 500. So these are the type of ETFs that are available in the US market and they're not available in India. That's what makes them really, hot to investors in India, that there's something that we can do that's not available here. And they're able to give you returns, short-term returns. Like, for example, I was talking about the leverage ETF on the NVIDIA, right? Like yesterday, NVIDIA earnings last night, the NVIDIA earnings came, but customers were not happy along for the forecast. If you look at few quarters back, right, and you saw NVIDIA earnings and the stock market shot up because of NVIDIA's stock, right? If you had invested in the leverage ETF for NVIDIA, you would have made 2x the returns. But again, the main thing over here is it's designed for traders who should be doing it in a short burst period of time. You can't keep this for long term. There's actually a really nice article that we have on our website talking more on leverage ETFs. I'll be linking this post the webinar. You can read a little bit more about it to understand the math behind it. And the next ETF that we're talking about is a very popular one. A lot of queries we get on this is Bitcoin and cryptocurrency ETFs. So far this year, we have seen $15 billion in crypto ETFs alone. Uh, because of the SEC approval, it's highly regulated as well, and it's much easier for you to get access to uh, owning a cryptocurrency, right, through an ETF. And because of that, it's easily you're able to, buy and sell as well. Some of the leading Bitcoin ETFs, I'm pretty sure you would have heard of these, are the iShares Bitcoin Trust, IBIT. 15 billion inflows in 2025, direct crypto or Bitcoin exposure, and you have a expense ratio of 0.25%. Fidelity wise, Origin Bitcoin FBTC 9 billion plus AUM. You have the Grayscale Bitcoin Trust ETF GBTC 20 billion plus AUM. And the reason why investors are falling in love with crypto ETFs today is because of the easy access. You can just buy and sell. You don't have to create another account for, buying cryptocurrency. You're just able to see it right there in your investing platform. There's no need to set up, like I said, there's no need to set up wallets or manage private keys. And of it being highly regulated, there's also a
Uh,
safety in mind.
Also, Rohan, just to add another point here, in terms of tax advantages of as an Indian resident, trying to invest into crypto, right? So, as many of you may know, in this budget this year, cryptocurrency as as a digital asset, has been sidelined by the Indian government. I mean, they have increased the capital gains tax to about 30%. But for general stocks and ETFs, it stays at 12.5 long term. So, in order to sideline that and also gain access to crypto capital gain, it's best to invest in cryptocurrency through ETFs because you're not going to be liable to pay the 30% capital gains and still able to cash in the capital gain through the underlying crypto asset in the ETF. So, basically, you're investing in an ETF, that's the asset class. But the underlying assets in that ETF is a cryptocurrency. So, you'll be able to cash in the price advantage while sidelining this new digital asset capital gains taxation that the Indian government has introduced. So that's a way to, maybe, I wouldn't say game the system, but being smart with how you deploy the money. If you want to have an allocation for cryptocurrency in your portfolio, best way to do it as an Indian resident is through ETFs. That's the whole point.
Next ETF that we're going to cover is international exposure ETF. So, like I mentioned at the start of the webinar, that you're able to invest in economies, you're able to invest worldwide. And this is some of the ETFs that you're able to, take advantage of. For example, go beyond US as a country. You can invest in countries like Japan or a Europe focused ETF. Like you have iShares, FTSE Europe ETF. You have ETFs for a lot of different countries. In fact, fun fact, you also have an ETF that's designed to invest in India, right? Like you see a lot of investors, like foreign investors investing in India through that ETF. Then you can also, invest in emerging markets like China, India, Brazil through the iShares MSCI Emerging Markets ETF, and or you're able to do a broad international exposure with the iShares Core MSCI Total International Stock ETF. So this is very broad. It covers both developed and emerging markets. So you're able to get an exposure like completely global, right? And biggest advantage is with one click, you can own hundreds of global companies, and you're not tied to the just to US market. You can have companies that are listed in Japan, Europe, China, anywhere in the world. Next, and last type of ETF that we are covering is the bond ETFs. I'm sure a lot of people know what bonds are, and we're not able to buy as of today on our platform direct bonds. So the way we can buy bonds in the US market is through bond ETFs. And why investors love them is the steady income that they provide and easy diversification. You're able to buy multiple bonds in one click and easy access. As like I mentioned, you can buy as low as $1. And some of the popular ETFs that are available in the US markets include US Treasury ETFs. A lot of customers reach out to us, like they want to buy US Treasury bonds, but they're able to buy it through these ETFs. Then you also have corporate bonds. For example, the iShares investment grade ETF, right? You're able to buy corporate bonds, and you're also able to buy international bonds as well. And you're also able to buy, lastly, the inflation protected bonds that are called TIPS. And the typical yield for these bonds range from around 3 to 8%. And you can find the right mix based on your goals and your investment strategy. Now, choosing the right type of ETF, and this is something where I'll invite Bhuvan to talk a little bit more about. on how to get started as a beginner investor and can we do as a person who has been in the market for some time. Bhuvan, can you just shed some light on getting started with
Yeah,
ETFs?
of course. I'll shortly share my screen here. But when we generally think about investing, right? We as Indians invest in the Indian market, we invest in the mutual funds, right? And they are thematic mutual funds. The way that's a way where you decide in your mind where you want your money to be, right? But now, as a global investor, I usually think of the US market. Hey, I want to buy Nvidia stock. I want to buy Apple stock. I want to do all this. Like, I want to be an owner of these companies, really good, great companies. And we kind of sideline, just in our heads, we kind of sideline the benefits that ETFs give, in terms of an actual portfolio construction. Because we are so much, buy Google stock separately, stocks. So here's the thing: there are two things that actually, benefit you while going for an ETF portfolio rather than a single stock, a separate stock portfolio. First is brokerage cost. That's a miss. Anyone. Let's say you buy 10 shares of 10 different companies. That's 100 shares, right? 100 shares is so most platforms like us, they charge per share. So that's going to be an extra cost for you. But let's say you buy an ETF of those 10 tech companies that are that are underlying assets of like a triple Q ETF, which has all the tech AI giants underlying assets. You anyway going to buy them separately in stocks. Why not buy that ETF and significantly reduce your brokerage cost as well, because the shares you're gonna with also a lot of time as well, because with just one investment you get access to all these tech AI stocks instantaneously. That was one point. Second point is that you're also much more efficiently able to diversify, as Rohan talked, uh, across different areas as well, not just sectorally, geographically, and even type as well. So I'm just share my screen. So a lot of people, especially us, we when we invest in the market, we try to build the portfolio. We tend to forget about income yielding assets. Uh, I would not specifically talk about the debt market in the US because I think as foreign investors, we usually tend to go more towards the equity market because interest rates are high in India. So it's rather to get your debt uh, allocation here as well because you get better return when you want to, buy bonds and things like that. But let's solely talk about equity. Is my okay?
Yeah, you were breaking a little bit. If you can just repeat the last point.
Okay, but yeah, I just want so I just said that I'll specifically talk about equity here, in terms of asset allocation and things like that. But yeah, I am I audible now?
Yeah,
I'm going to share
you
my
are,
screen.
Bhuvan.
Okay. All right. So, we talked about the power of diversification, so here's the thing. So let's construct a sample portfolio. Usually, I mean, an average Indian investor is 40s or 50-year-old. They want to retire, right? But they have the disposable income to actually invest overseas, other than invest in India. So mostly what they're looking for is a growth potential as well of capital gains, but they're also looking for some kind of income in dollars coming to their portfolio so that they can use that money to either do dividend reinvestment back into the portfolio or use that money for vacations or just in a yield that the portfolio can produce for their consumption or other kind of whatever they want to do with it. So in terms of so we're going to create a sample portfolio here. We're just going to just browse through it and look at how ETFs actually build a portfolio in a very, good way for you. And you can actually allocate fractions of your money into an ETF and have automatic diversification that way rather than going for individual stocks. So here's what we're going to do. The rule is 50%, we're going to 50% allocation is going to go towards growth potential. This is the money, you're looking to invest in large cap, mid cap, really, established companies and also emerging companies that have shown good results. And these are going to be, increasing in the future. This is solely for your capital gains. The 30%, so that brings us to 80%. 30%, we're going to look at dividend producing, income producing ETFs, or assets that, give you also an income cover year on year. So let's say your total return for the portfolio was 15%. 12% was capital gain, 3% you actually cashed out. So we're gonna talk about it. The last 20%. So the first 50 growth, 30% your income producing. The last 20% we're gonna use for high risk plays. I mean, this is the last 20% is where you should go for single stock investments that you think are emerging markets, have bullish sectors. It can be AI, it can be hydrogen, it can be, things like that. So let's look at this. So this is a complete 100,000 portfolio, 50% growth, 30% income, and high risk would be around 20%. So core growth foundation would be your triple Q, VGT. I would not go into the names of these, but these are, you can always do your research. We'll be also sharing this sample portfolio with all of you guys, so you can always go into and check for yourselves. But yeah, the growth is your first step of, with just one investment, you're going to gain access to all these, well-established companies which are diversified within the portfolio. So it saves you time, it saves you all the complexities. The second tier is your income generation model, which is going to be your covered call ETF. So a lot of covered call ETFs the fund manager will sell calls on the underlying stock, and the premiums that are received by selling those calls are distributed to you as an investor. So they are very high yielding ETFs as well. They're dividend ETFs. So dividends in the US, I mean, dividend yields of a portfolio in the US range from 2% to 3% if you incorporate them. So usually we're looking at a 15% return on average, which is, which is this anticipation of the past data, which is a 15% portfolio growth, which is kind of not aggressive, not conservative. Conservative would be 10 to 11. Uh, Medium would be a 15%. Aggressive, if you think you're very bullish, if the market is it's going to be 18 to 25. So, but we look at a 15% return. Out of that 15%, 12% we look for capital growth, and the 3% we're looking for a dividend yield that is going to come out of as an income generation. Um, which you can be on the other side of things. You never know how the market performs, but this is how you actually deploy your capital to do the best of things. You also want income, you also want capital growth, and you also want access to these really bullish sectors like quantum computing, AI, semiconductor revolution, this hydrogen, things like that, robotics, as Rohan spoke about. So keep that last 20% for that. But the first 80% should be split between growth and income. And you should always, ETFs are the best way to generate that portfolio, which is, as I said, one investment, highly diversified altogether. Um, so then later on, you can always, I mean, I'm talking about portfolios, but this is generally an investment strategy. You can always say, hey, I want to increase the dividend yield and cut back a little on because, hey, I'm retiring now. I need that disposable income. I need that cash to, just fuel my retirement in a way. So you can always kind of cut back your growth holdings, and that should be the ideal thing to do actually. Whenever you reach your retirement age, reduce your risk from the highly risky investments and cut towards the income generation assets that really help you float your boat through retirement. So that's usually how things are designed in a way. But if you're 40s, 50s, keep the split this way so that you get both the growth potential and the income. So now, I mean, this is what we're going to share with you, how, you can, I'm not going to speak about like the nitty-gritty of things, but yeah, this is something that, you can have a basic framework to use when you start your online journey. And this is, in fact, I mean, this is a portfolio created from past, just a disclaimer here. This is a portfolio created from past performances. This is not in any way promoting any company or any, uh, I would say discretionary investment advice. Um, so yeah, so now you can optimize the portfolio, profit, growth and income in a way, reduce your triple Q, increase your covered call ETF allocation. So let's say it's a sample 100,000, right? So let's look at what the annual dividends would be. So the enhanced portfolio will deliver a 2% dividend yield. So the 50%, 30%, and 20% by sectorally portfolio arrangement. So given your 30% will actually generate a 2%. So when we talk about yield is the actual cash given out during the year. It's the actual cash in your investment account. Now, what you choose to do with that cash, you can either reinvest it, that will enhance your coming 5-year annual growth. In a way, it will increase, or you can take it out and do whatever you want to do, or live by it. The total return is always the growth, the capital gains, and the yield. So many people, they kind of get confused between, they just call the capital gain as their return. It's not just that. You also are gaining dividend yield, which is also part of your annual return. So 15% is the midway point in the US market, given what we have seen in the past. So that's what the thing is. So yeah, always, 1 year and 5-year projections are always a good way. You can always use a good tool like you have a stock screener you can use, or can you also use Chat GPT in that case to give you a projection and see how you can optimize it further. But yeah, the framework is important. So the main point of this kind of a segue was to give you an idea of how the framework should work for you, and how it can benefit your goals, and what you can do, and how ETFs play a role in portfolio generation. So I am a personally ETF fan because of the mentioned benefits and lower costs, uh, better than managed funds. You can also, it's very, if you look at the US market right now, managed funds are actually going downhill because no one can beat the S&P 500, because the US market is so kind of experienced and matured in a way that arbitrage and things like that, no one is able to beat the S&P 500 as a broad market comparison. As far in it's I was shocked to see that fund managers are actually beating the broad market index. So that shows, that's actually a good point to look into in a way, because I think the markets are less kind of the information is not going to the distributed really quickly here as compared to the US, because it's a mature market. So here people are able to exploit those arbitrage opportunities more quickly, and quantitative trading is less here as well. So that also explains a lot in terms of how fund managers can exploit arbitrage. But yeah, that was the gist of it, and I'm sure this gives you kind of a framework to look at in terms of building your portfolio. And I would say good luck on your investment journey. We'll be taking questions in the end, and I'll be also touching base with all of you guys and discussing what we can do to help you out. And yeah, that's it.
Thanks, Bhuvan. I'll just share my screen.
Of course.
All right. So moving on, just want to talk about top 10 US listed ETFs by net flow. So when I say net inflows, meaning the number amount of money that's gone into each of these ETFs, how much money has people spent to buy these ETFs alone in 2025? So you see some of the notable names, right? Like the Vanguard S&P 500, most vanilla ETF out there, just covering the S&P 500. People are just buying that. Like Bhuvan mentioned, right? People are not able to beat that. Funds are not able to beat the S&P 500. So a lot of money is going into that. Then you have other ETFs such as the total stock market ETF. Then you have ETFs such as thematic rotation. You have Bitcoin over there, as we have seen a lot of inflows into Bitcoin. Then you have another popular one called the Invesco Triple Q Trust Series 1 that's more focused towards tech. And you see a lot of different other types of ETFs as well, as you can see on the screen. Now, at Stockle, right? What are the trends that we have noticed what investors are buying? And these are the top 15 ETFs that have been traded on our platform over the last 1 year. So, as you can see, right, uh, first one is, like I mentioned earlier in the leverage ETF section, the Granite Shares 1.5x long NVDA daily ETF, also known as NVDL. So, it gives you the 2x leverage on NVIDIA. Uh, as you can see, a lot of customers are getting aware, of these leverage ETFs or the different types of ETFs that are available in the US market, and they're able to capitalize on these unique strategies not available in Indian markets. You're also able to see like a uh, ETFs known as BITX, 2x Bitcoin strategy ETF. Another leverage ETF people are buying to capitalize on the growing Bitcoin market. You're also seeing, for example, few funds, new funds like the Fidelity Ethereum Fund, FETH, another great ETF that's just recently out. And you're also seeing a lot of inflow. We're also seeing a lot of inflows into gold ETFs. So the advantage here with gold ETFs is you're also able to capitalize on the USD appreciation as well. Few resources to end the web before we end the webinar and head over to the questions. Just wanted to talk a little bit more on how do I search for the ETFs that I'm looking for? Where do I go to screen them? How can I get news on, what's trending? Where do I go to buy? Uh, some of the platforms that I personally like to use is ETF.com. It's a basically a portal where gives you a comprehensive detail on what you need to look for, what type of ETF it is. It gives you a lot of research, a lot of details on it. And then you have your morningstar.com. It basically gives you ratings on, okay, is this ETF worth buying? Gives you all of those recommendation. It also has like a subscription model as well if you're interested. And lastly, and this is something that I'd like to, in fact, share and show this to you is the ETF DB.com, right? It's like the holy grail for ETF. This is where I started screening a lot of the ETFs that I personally like to, put in my portfolio. I think Bhuvan also has another one called Finviz. He likes in this, you will get to see all types of ETFs that are available. In fact, you have like on biotech, commodities, healthcare, AI, and you can in fact screen them with the ETF screener. There's a huge screener right here. It becomes really easy to use as a person, like as a beginner investor looking to screen stocks. It's something that kickstarted me into my ETF journey as well. I use this. Then you also have, by ETF types, you have different types of ETFs. As you can see, there's quite a lot of stuff. You have more regions, you have by countries, you have different types of bonds, a lot of types of bonds you have on currency, if you want to have ETFs on currency. Like I mentioned, right, there's a lot you can do right here. Like I said, the holy grail for finding the ETF that's right for you. Moving over to the questions. Uh, if you have any questions, we're happy to take them right now. Feel free to uh, use the Q&A box to type in your questions. We'll be happy to answer them. If you'd also like, you can just raise up your hand and we can, enable you to speak your question out. Anjun, I think you had raised your hand. I'm allowing you to talk. Feel free to ask your question. Bhuvan and
I
I
think
can,
Ram.
help answer.
Yeah, hi everyone. So I have
Hi,
this one
Anjun.
question. Can you provide some advisory kind of service, or if you cannot, at least you can connect to some advisory kind of services where I can build a portfolio of my choice,
Um, uh,
subscription type
yes, Anjan,
models.
I mean, yeah. So right now at Borderless Stockle, right, we are kind of transitioning. So right now we are mostly, we're just giving out the platform as a kind of do-it-yourself way where clients can register and make their own portfolio. We're transitioning more into a wealth management team as well. And we are, right now, I mean, I'm a wealth manager. I joined Stockle as a wealth manager, as a business development person. So I kind of, I have a client list under me. So I manage clients so it's a one-to-one thing. But at the end of the day, officially, it's the clients make their own portfolio, but we are there in terms of, giving out suggestions and making kind of sample portfolios for you. We're
So
transitioning into more into a global wealth boutique, but that's in the right now. But we do help clients on a one-to-one basis.
So I would just require, I mean, I
Yes,
would just
did that answer?
request you kindly correct me over the call so that I can discuss my prospects about my portfolio
Sure,
to build
Anjun.
my
We'll be
Yes,
portfolio.
connecting
yes,
with you.
we definitely do that. Yes, we do
Yeah,
that.
yeah, please, thank you.
Thank you.
Any other questions?
Thankfully, okay, yeah. You can also use the Q&A if you don't want to speak up. You can use
Yeah. Regarding the material that Bhuvan was sharing, right? We'll be sharing it to you by tomorrow. You'll expect an email from me, the people who've attended the webinar, and whoever is registered for the webinar as well, who couldn't attend, will also get a recording of it. So you can see the webinar again, and you can also go through the material too.
I think, can you list like Bitcoin ETFs and Ethereum ETFs? Bitcoin ETFs, you got your IBIT and things like that. But yeah, it's usually, I mean, I don't have on the top of my head, but yeah, that's usually IBIT is what people go for. Yeah, you can always use online resources. Ethereum, yes, as well. I would also look at, Circle now. It's not an ETF. Circle it's like Coinbase only, but stable coin is coming into a lot of traction. So Circle provides kind of, so stablecoin is cryptocurrency actually backed by the currency itself. So the USD has Tether, which is USD backed cryptocurrency, which is going, gaining a lot of traction. So keep an eye on Circle as a company because they are the technology providers for that kind of cryptocurrency. So Circle, SRCL, I think I believe is the ticker, which is you can always keep a watch list on that. So that's a good good kind of a tip for you guys. How can an NRI register on your platform? NRIs can register on a platform only if they're not residents of the US or Canada. Usually, we have most of our clients are Indian based and MENA, Middle East, MENA region based, so Qatar, Oman, UAE. Also, we have clients from Singapore, Southeast Asia as well, Africa as well. So it's better for you to register on the platform. Just give us, so you'll be prompted to give us two pieces of ID, one national ID as a resident where you live, and one address proof. So it can be a utility bill or bank statement that has your address on it, given that you actually live in that country. And that, yeah, it's a pretty streamlined process. Circle, yes, SRCL.
Bhuvan, we do have
And
a
it'll be
question
great,
on taxation.
talking to you guys. Later on, I'll probably, Ronan is going to share the list, and it'll be better if we can, chat on one-to-one basis and see how we can start your investing journey.
Yeah.
But yeah, it was, great having you guys. Any more questions you have,
Uh,
either you
there,
can email us
Bhuvan,
or.
there is a question on taxation on long-term and short-term capital gains for US based portfolio ETFs that you buy in the US.
Yes, it's the same as so as per the last budget, right? So the timelines how the Indian government has done is if you buy and sell an asset in the US, be it a stock or an ETF, within the first 2 years, you have to pay an income tax on your income slab rate, which is, let's say, if you're a high income earner, your income slab is 30%, 25%, 30%, then you have to pay that much if you sell it within the 2 years. It'll be considered as a short-term tax. If you hold it for more than 2 years and then let's say sell it after 3 years, then it's 12.5%. So it's a long-term capital gains tax. I haven't started using it. How long? So the funds, if you're sending from overseas, if you're sending from India, so the investment account is domiciled in the US, Drive Wealth being the broker, and JP Morgan being the investment account where it's held. So the funds are transferred through SWIFT, so through a wire transfer from your Indian bank, whichever bank you're using overseas. If you're in a different country than India, they are transferred through, if you're in through an LRS, wire, this is a normal wire transfer. So you just add your payee, your account as your payee, and you add the LRS investment purpose code. We usually help you one to one, but it's not a big process. It's just as you can use your net banking and input your investment account details as a payee, and then send a wire transfer in USD. And it will take around, luckily, if you're lucky, usually 2 business days it does, because that's an international wire.
Just to add to what Bhuvan is saying, like if you're a customer who's attending this webinar and have never funded your account and you really want to kickstart your journey, we want to talk about, I just want to take a minute to talk about borderless money account. So it's only live for customers who have never funded their account earlier. So if you open a borderless money account, you can fund your borderless money account from India. You can just send the money, like for example, $100, right? Send it to your borderless money account, and then for borderless money account, you can send it to your investing account, right? So right now it's only enabled for customers who have never funded their investment platform. We are bringing that functionality to our customers who have funded their account, where you will be able to transfer money from your investment account into a savings account that holds in US dollars, rather than bringing that money back into India. So that's the added advantage if you're a new customer and would like to kickstart your journey. That's a feature that we are providing at the moment. For funded users, we will soon get back to you. We are working on the compliance part of it, so stay tuned on that.
So I actually thank you, Rohan. I kind of missed that step. So we have introduced the multi-currency account. So in addition to investment, that we help you with global investment, we also are helping you now with holding different currencies. So it can be for investment purpose, it can be for travel, it can be for your supply, whatever you are earning. If you're a doctor, freelancer, things like that, you earn in a different currency, you can directly get that currency
Yeah.
uh, invest transferred over to your multi-currency account, which we're calling a borderless account. So that middle layer that we introduced also gives another advantage. Let's say you sell some of your investments in the US, as Rohan said. Most of the clients, when they sell, they to India, wherever they stay, and they have to convert their currency back to their domestic INR. Seen what INR has been doing in the past 4 years. So we introduced a middle layer so that the clients can actually, get money back in USD and also convert that on in the same account. You can hold apart from USD five more currencies. So on using Google Rates, you can convert that USD into account and use, like for
Yeah.
example, Canadian dollars. So that's an added advantage. And thanks, Ron, for
Yeah.
bringing that
Uh,
attention.
just as another note, we'll be having another webinar on, multi-currency account, how it is, what is it, how to get started. We'll have a webinar in the month of September, so stay tuned for that. We're also having a really
Yes.
huge announcement as well on that.
SRC,
Sorry, Bhuvan.
CRC, sorry. Yeah, it's just a client. I'm just
Okay. So, any other questions? We'll be happy to answer them. Any last questions?
great. I think
All right. I don't think there are any more questions. So thank you all for joining. I hope this session was informative. We are able to pass on some actionable insights to you guys. There'll be a feedback email that's being sent post the webinar. If you could just leave a feedback on how the webinar went, that'll be really great. Tomorrow you'll receive an email from me regarding what Bhuvan was sharing earlier, documentation on portfolio allocation, how to get started, sample portfolios. I'll also be linking an article that I have mentioned that talks about leverage ETFs, a little bit on math on that. It's a little harder to explain on call, but if you can read it, you'll understand the math behind it and why it's not suitable for long-term investments. I'll also be sharing a document on Bitcoin ETFs as well, uh, popular ones right now. Why invest in Bitcoin? So just look forward to my email tomorrow. And in case you have any other queries, please reach out to customersuccess@stockwell.com, or you can send me an email as well. I'm Rohan, so you can send me an email at rohan@stockwell.com. Thank you all for joining. Thanks, Bhuvan.
thank you. Thank you.